Good morning. In this video I'm going to model for you how to analyze business transactions. Specifically, we're going to take a look at how accounts are affected during transactions, and then we're going to apply that and we're going to record it using the accounting equation. And this is done using a 5-step process. The first step is we need to ask ourselves, did a business transaction occur? Remember, business transactions only recur when what was impacted can be quantifiable. In other words, the monetary unit assumption. You only record those transactions that have a direct impact on the financial condition of a business. Step 2, we're going to identify, based on what we read in the transaction, what are the two accounts that are affected as found in a business's chart of accounts. Well, we learned earlier in the week that every business creates a chart of accounts. It's just a numbering system. Assets usually begin with 1, liabilities with 2, owner's equity with 3, and so forth. And the purpose of this is so that businesses can easily categorize all the different accounts they have, which makes it even easier for them to locate and retrieve financial data when they need it. Step 3, we're going to determine how are these accounts classified. Well, they fall in one of 5 options. It's either an asset, liability, owner's equity, revenue, or expense. Well, this is going to be an easy step for you because once you identify which accounts are affected, all you have to do is look above it, and above those accounts will be the category. Now, later in the year, I'm not going to give you these classifications. You're going to have to determine based on the specific account name, is it an asset, liability, owner equity, revenue, or expense? Step 4, using the financial figures in the transactions, you need to determine, is this account going up? Is this account going down? Or perhaps both accounts are going up, or both accounts are going down. And then the last step is the most important. We're going to test our work to make sure we did it right, and we're going to record this using the accounting equation. And we need to make sure that after we record this, the left side of the equation is still equal to the right side. And this is known as double entry accounting. And double entry accounting, you can always assume 100% of the time that every business transaction will affect 2 accounts. Double entry accounting, every transaction will always affect 2 accounts. That's a new vocab term that you're going to need to know. Let's go ahead and get started. Okay, first transaction. Mr. P invested $25,000 of his own money into his new business, Mr. P's Pizza. Is this a business transaction? Well, for the sake of this activity, you're going to assume all of these are business transactions. So let's skip to step 2. Based on that transaction, what are the specific accounts that are affected as found in our chart of accounts? Well, I invested $25,000 of my own money. Right away, I know cash is going to be affected. I took $25,000 of my personal money and I deposited it into the business's bank account. So my business's cash account is going to go up. Whose money is that? Well, that's me, the owner. I took my own personal money, I transferred it to the business, and so Mr. P's capital account is also going to be affected. Why? Because I have 100% claims to that cash. I didn't borrow it, it's my money. And Mr. P Capital is where I record my claims to the assets. Now we need to record this in our accounting equation to make sure it's balanced. So down here I'm just going to write cash plus $25,000, and I'm going to go to owner's equity, and I'm going to record Mr. P Capital plus $25,000. And I'm going to test it to make sure. Step 5, is the accounting equation in balance? Well, sure. If $25,000 went up on the left side and $25,000 went up on the right side, then it's in balance. Next. Transaction B. Mr. P purchased a $5,000 computer system using cash. Step 2. Identify the accounts affected as found in our chart of accounts. Well, I bought a computer system. To me that sounds like an asset, so I'm going to look at my asset. Boom, there it is. Account number 110, computer system. Now, how did I pay for it? I didn't borrow it. The transaction said I paid cash. So cash is going to be affected. I know they're both assets. So I'm going to go down to my accounting equation, and here I'm going to write down computer equipment. That went up $5,000. And cash. That went down $5,000. Now in this transaction, nothing was affected on the right side of the equation. One asset went up, which is computer equipment. One asset went down, which is cash. So in essence, they kind of wipe each other out. I increased my assets by $5,000 and I decreased it by $5,000. Therefore, the equation is still balanced. Transaction C. Mr. P purchased a $10,000 delivery truck on account from CarMax. The key word in this transaction is on account. What does that mean? That means I bought this on credit, so I'm going to have a liability to CarMax. Sure enough, if I look at my liabilities, there it is, account payable CarMax. I bought this asset on account. I'm going to have to pay CarMax eventually in the future. I owe them money. They're my creditor. Why do I owe money? Because I bought a delivery truck. So my asset, delivery truck, went up. My liability, CarMax, went up. So I'm going to go to the next line here, and I'm going to record this on line C. I'm going to increase truck for $10,000, and I'm going to increase my liability, account payable, CarMax, for $10,000. Is it in balance? Sure. $10,000 went up on the left side, $10,000 went up on the right side. Transaction D. Mr. P sold $500 of pizzas to Allstate Arena. Step 2, identify accounts affected. Well, I saw the word sold in there, so that, to me that sounds like revenue. Sure enough, here it is, pizza sales. That's the account affected here. Now, this transaction didn't say anything about on account. Therefore, I can assume that Allstate gave me cash. So, I'm going to go down to transaction or line D, and I'm going to record cash plus 500. And I'm going to go to my revenue side, and I'm going to record pizza sales plus 500. Is the accounting equation in balance? Well, cash went up 500, that's on the left side. Sales went up 500, that's on the right side. Now, some of you guys probably wanted to record account receivable. Again, Allstate Arena does not say they bought this on account. It just says I sold them $500 of pizzas. Therefore, we can assume that they paid me cash, which means I don't have an account receivable Allstate. Transaction E. I sold $1,000 of catering sales on account to Monster Tools. Keyword, on account. Monster Tools did not pay for this yet. So let's go to my chart of accounts. I sold something, so let's go to the revenue section. I sold catering, so I'm going to record that in catering sales. Monster Tools chose not to pay me, so I have an account receivable Monster Tools. That's an asset account because within 30 to 60 days, I expect that they're going to send me the money they owed for the catering I gave them. So now let's go to line E, and let's go account receivable Monster Tools. How much? Well, we sold them $1,000, so that's going to go up $1,000. And the sale we made was catering, and so that went up $1,000. Is the equation in balance? Yes. Assets went up $1,000, catering sales went up $1,000. Transaction F. Mr. P paid $250 in advertising to the Chicago Tribune. That sounds like an expense to me. So advertising is going to be affected, and cash is going to be affected. Let's go ahead and record this. How much cash did I lose? I lost $250. So this is going to be minus $250. Why did I lose it? For advertising, which is an expense. And so this is going to be minus $250. Is the equation in balance? Sure. Cash went down $250. Advertising went down $250. Now, if you notice, the equation looks different. It's called the extended accounting equation because we added revenue and expenses. Now, why are we adding revenue? Because when a business gets revenue, whose money is it? It's the owner's. So the owner's equity, his claims to the assets must go up. Well, then why are we going to subtract expenses? Because if the owner is spending money, his claims to the money must go down. So expenses is subtracted. Now, I want you to go ahead and do this on your own using problem set A as posted on the blog. You're welcome to go back, relook at the video if you need any help. Otherwise, when you're done, check your work with the answer key and or call me over if you have questions.